Okay, I think that we can start. We already have quite a few people there. First of all, let me introduce myself. My name is Gerardo Gutierrez, originally from El Salvador. I've been working with TPA for the past couple of years, working in different projects such as TPA documentation, CBCR, of course, and valuation projects. And then we also have a wide variety of service, not just transfer pricing. We'll let Angelo Girardi introduce himself.
Yes, thank you, Gerardo. I'm Angelo Girardi. I'm originally from Italy, and I've been working as a junior associate in transfer pricing practice here in Amsterdam for slightly less than 1 year. I'm glad you all joined this webinar, and I will proceed with my intervention on the EU, the public CBCR directive. Thank you, Gerardo.
Okay, we can go to the next slide. These are the topics that we will be discussing today. We will do an introduction of CBCR. We will release a poll in a few moments just to understand who is our audience, just to see who is involved in academia or heads of tax or tax administrations. We want to understand who we're talking to. We're going to discuss CBCR rationale and risk assessments made by the tax authorities. Can you go back to the just the introduction? We're going to discuss CBCR reporting, the filing process, how it looks like. We're going to discuss the CBCR content. We're going to have a look at the table 1 to 3 and some additional provisions that need to be included there. Certain specific information, the format. We will look at examples of practical problems, common mishaps that maybe some of you have encountered already or will have to deal with if you have not done CBCR before and you are about to, your company is about to enter this. Could be a painful stage. It depends on how the corporate governance is, how you extract your information, how you have managed with how the communication is between different departments. We will look into that a little bit further to give a little bit of suggestions here and there. We will discuss public CBCR. Our expert in EU law, Angelo, will touch upon certain topics that are quite a hot topic right now about the implementation. Some problems. We will see the similarities between the CBCR by the OECD stemming from Action 13 and the implementation of the directive from the European Union. And then at the end of the session, we will have a little bit of a space to discuss some Q&A. We will have a few other polls as well, just to see what the audience thinks regarding the public CBCR in general. We want to know what you think about the concerns that some people have regarding confidentiality and some other topics. So I think that we can go to the next slide. Yeah, can you please help us out with the first poll? Yeah. Okay, I just want to ask the audience to answer this poll. We just want to understand how the distribution of our audience is. And my apologies if your role is not included. I'll just give some time for everyone to answer. Just a few more seconds. I think that we probably have already a few answers coming up. Okay, I see that most of the audience, big percentages, 38% is like tax manager. Second category is in-house head of tax. We have some transfer pricing consultants, official government officials, and other. No students. Okay. Which country, which industry do you primarily work in? We have other, it's not specified. Manufacturing, technology, banking, finance, healthcare, energy. Level of experience with country by country reporting. I see that 42% of the audience is a beginner. So in this first part of the session, we will try to dive into the specifics on how the report looks like. We have prepared for. We're trying to cater for this part of the audience. We have a more experienced part of the audience, which is a 25%, and intermediate 31%. And are you directly involved in the decision-making process to tax transparency? Most of them said no, and we have 44% that said yes. In which geographical region you are primarily focused? We have half of the audience is involved in global compliance. Okay, let's go to the next slide. Thank you everyone for your participation. Go to the next. Okay, so the background is that the CBCR is stemming from Action 13. It's a project that emerged in response to concerns about multinationals exploiting gaps and taking advantage of mismatches. And in 2014, the template of the CBCR was released in the Action 13, and the final report was released in 2015. The Action 13 specifically addresses transfer pricing documentation, aiming to enhance transparency, provide tax authorities with insights of multinationals' operations globally. It was considered a key milestone within the Action 13, introducing a standardized framework for reporting the global allocation of income, taxes paid, and economic activity. The CBCR disclosure requirements are that the annual report for each tax jurisdiction in which the group does business has to be disclosed, the amount of revenue, profit before income tax paid and accrued, total number of employees, identification of each entity within the group doing business in a particular tax jurisdiction, for example, and to provide an indication of business activities. Consistent articulation of TP positions between the master file, the local file, and the CBCR, meaning that these three documents need to speak to each other. Whatever is disclosed in the master file has to communicate to the CBCR and with the local file, otherwise we'll be creating tax risk. And yeah, this information is shared between tax authorities, so it better makes sense. And for the companies that are falling into this category for the first time, it might be quite tricky in the sense of getting the information in a common standard, but we will discuss this a little bit later. Also, the reports are typically prepared by the ultimate parent entity in the multinational group, given the fact that they have a better view of the bigger picture. And the long-term goal for the tax authorities is that this helps them identifying those multinationals whose structures and activities may give them greater opportunities for tax avoidance practices, or identifying companies that might have fewer opportunities as the bigger ones. It helps improve the quality of conversations between tax authorities, these bilateral collaborations, multilateral collaborations. This gives the tax authorities the opportunity to do resource deployment, targeting or auditing inquiries, depending on how well they use the analytics or the data that is coming from the CBCR report. Then tax authorities have a sea of opportunities in the sense on how they decide or which strategy they decide to use. This also helps to detect artificial shifts or profit substantial income. And it also gives a listing of constituent entities. This is a definition we will look a little bit further. And also the CBCR, we have to note this is related to the taxpayers' rights. We have to note that the CBCR report should not be used as a substitute for a detailed transfer pricing analysis or of individual transactions and prices based on a full functional analysis and full comparability analysis. Should not be used by tax administrations to propose transfer pricing adjustments based on a global formulary apportionment of income. The initial timeline of CBCR, we will go into public CBCR later, was starting in 2016 was the first fiscal year for reporting. It ended by 31st of December 2016, and the first the deadline was 2017, and the deadline for exchanging information between tax authorities for the first year was 18 months. Now it has been reduced to 15 months, and it has been maintained like that. And the CBCR is also triggered by a revenue of 750 million euros. But you have to be careful because each jurisdiction might have their own rules. We have seen that in practice, that in some cases, like Colombia, for example, they use tax units. So you have to make sure to make the conversion. At year end, you could also use. Well, this is another question we might be discussing later. Like which type of exchange rate do you use at year end? Do you use an average at the beginning of the year? There are several approaches, and it will all depend on the tax jurisdiction where we're dealing. For example, in Argentina, you consider the amount, the global revenue in euros, for example. So you have to be careful and have a deep dive into the specifics of each country where where the multinational company is operating. Also, there is not only the deadline for filing the CBCR report, but you also have the first notification. Under the OECD group, entities must file notification about reporting entity before the end of the reporting fiscal year. Deadlines are subject to change as when the countries implement the CBCR legislation. It might be that there are some extensions given. Sometimes there are in a tax jurisdiction, the tax authorities might be implementing a new platform. So we have seen that in the case of Poland for this year for the filing of other forms, but we also saw that a lot during COVID, many extensions being granted. So this is something you need to be really careful of. Because if we see, if you look into the different deadlines, it goes from, for example, for fiscal year 2023. The first notification in Dominican Republic goes from the 30th of September of 2023, and it can go up to the 28th of February of 2025 in Argentina for fiscal year 2023. So it goes all over the range. So you have to make sure you keep a track of the deadlines for the first notification. And what you do in the first notification is that you inform the tax authorities of the status. It doesn't, even if a company does not fall under the threshold of presenting a CBCR report, in some jurisdictions you still have to present a first notification. So you let the tax authorities know when it's expected, or if it's not expected, that the company will reach the threshold. And the non-compliance can carry fines, of course. Okay, so I think that we can go into the next slide. So we will look a little bit into the rationale of the CBC report by the tax authorities. Of course, we have the footprint of a group in a tax jurisdiction. This could mean that a group with a small footprint has less potential to pose significant tax risk. Group activities in a jurisdiction are limited to those that pose less risk. This could be explained in many cases that an entity whose main activity would typically pose lower tax risk but may still engage in certain tax avoidance practices. There is also the results in a jurisdiction may deviate from potential comparables. Differences, for example, between jurisdiction and the chosen comparable could be driven by tax avoidance practices, but this could be explained by the chosen comparable that may be unreliable, or there may be commercial factors to explain any difference. So there are certain elements. What I'm trying to say is that there are certain elements that might indicate a potential risk of tax avoidance practices. However, under table 3, we will later see the structure. You will see that you can give you can argument on why the results, or why this potential tax risk indicator is coming up from the CBCR report, because this is not mere filing the consolidated numbers. There has to be an explanation, of course. There has to be an in-depth analysis of the data, and a proper explanation must be provided for the tax authorities. Sometimes there are jurisdictions with significant profits but a little substantial activity. This might indicate that profits might have been shifted, but as an explanation, there may be a commercial reasons of why results in a jurisdiction might be seen higher relatively to the activity measures reported in the documents. There could also be jurisdictions with significant activities but low levels of profit, but this could be explained by that some activities within a group may be more asset intensive or staff intensive than others. For example, administrative functions may have a low profit per employee, for example, compared to the rest of the group. Also, a group has activities in jurisdictions that pose tax avoidance risk, but there might be a reasonable or a proper reason for to explain why a group has activities in a particular jurisdiction, like real business reasons. If we go to the next slide. Okay, a group can also have mobile activities located in jurisdictions where a group pays a lower rate or level of tax. This could also be explained that from a profit, mobile activities may be correctly attributable to the low tax jurisdiction, so long as there is sufficient activities. Just another example. I don't think we will go through all of them because of time, but for example, the IP can be separated from the related activities within a group, but as an explanation, and I'm talking about explanations that go in table 3. The IP might be held in a particular jurisdiction for non-tax avoidance purposes, so long as the royalties paid for the use of IP are at arm's length, and there are no other indicators of tax avoidance, or the tax risk to a jurisdiction may be low. We'll do a couple more bullet points. I think that It's quite important to explain how these potential tax risks can be justified. Just to give you a few examples in case you are having to deal with it. So in the case that a group includes dual resident entities, this can be quite this could mean potential risk, but most entities that are listed in different jurisdictions of residence or incorporation will not necessarily be dual resident because of the tiebreaker rule applicable from the double tax treaties. So this can be an alarm bell, but just be aware that there is also the double tax conventions that can cover for this. Also, a group can include entities with no tax residence or stateless revenues. And in many cases, an entity that is not tax resident anywhere will be transparent for tax purposes. And in many cases, the revenue that may be taxable on a constituent entity elsewhere could be taxable elsewhere in the group. Okay, we can. I think we can move to the next slide. Yeah, this was an outcome of the first year the CBCR came into to action. You can see this is you can see the allocation of total profits or total income revenue. We have the variables of higher ETR with or lower profits or higher profits. So we can see that from the participant entities or companies that reported for CBCR, 45% of the total income came from jurisdictions with a lower effective tax rate and higher profits. We can move to the next one. We're going to release the second poll just to see what the experience has been, at least for those that have had a little bit more experience. If you haven't, you can say not applicable. We will give a few moments for the audience to answer. I think that we might have a good number of responses by now. So for the team, let me know if this is I cannot see it for the team. Well, I cannot see the results yet, but otherwise we can. Okay, they can mark. Okay, we see for the first question, how would you describe your experience with CBCR reporting? 41% of the audience says they have never done CBCR. 11% answered that they have done one CBCR report. 15% has done more than one. 22% says that they are familiar with CBCR but have not been directly involved. And 11% for the person is not applicable. So we see that the majority of the audience has never done CBCR report. But second question, if you have experience with CBCR, how would you rate the complexity of the process? We see that 52% has no experience. Then the second option is moderate, 26%. Complex is 11%, and very complex, 11%. I believe that this may vary depending on how big the company is, and it happens that as a multinational group grows and they acquire operations in different jurisdictions, they might have different ERPs locally. So sometimes it might pose a real bit of a challenge converting that information or converting for the standards in which this has to be disclosed, namely IFRS, US or Dutch GAAP, etc. We see the third question: what challenges, if any, have you encountered in the process of preparing CBCR reports? For 56% is not applicable. For the rest, the data collection across jurisdiction, what I just mentioned, and in my experience, one of the most challenging parts. Interpretation of CBCR guidelines. There are a lot of gray areas. Of course, it is not all disclosed there, and in many cases, you need to go to the tax authorities to understand what is going on behind certain decisions or requirements, and also technical expertise. In this case, the presentation of the CBCR report in itself is made through XML. We will see it a little bit further. We'll try to get there. The fourth question: have you faced any specific challenges related to the public disclosure aspect of CBCR? For most, is not applicable. 30% said no, and 4% said yes. How confident do you feel about the accuracy of the information presented in CBCR reports? We see that 26% they feel somewhat confident, 7% confident, and 11% not very confident. If you are really struggling with the accuracy of the information, you really need to have a conversation with the internal team and decide what, or check what the structure, the corporate governance structure is, to see the allocation of roles, and this will result more challenging for the groups that are reporting for the first time. And the last question: would you be interested in more training or guidance on CBCR preparation and compliance? 59% said yes, definitely. 15% yes to some extent. 7% not at the moment. And 19% not applicable. Thank you, everyone, for participating in our second poll. We can move forward with the rest. We will see now what's the filing process. Go to the next slide. So as we discussed, the CBCR report is filed by the ultimate parent entity. And we already saw the deadlines for exchange of information, which is 15 months. And usually the deadline for CBCR is 12 months after the end of the fiscal year. You have to make sure that you are covering the broken book entities, depending on the jurisdiction. So we see that this is filed to the tax authorities, and then in 15 months or even earlier, this is shared to the tax authorities. The format, as I already mentioned, is XML. Is really easy for tax authorities to communicate through this. So the process of filing, every tax every jurisdiction has their own platform. The buttons might look slightly different, but the structure of the report should be the same, as most of the jurisdictions are following the guidance given by the OECD of using the three tables that we will have a look now. Can you please go to the next? Yeah, the OECD has released some guidance. It's mostly for tax authorities, but also for in-house teams that decide to do this internally. Let's go to the next slide. So as I mentioned, the content is table 1, 2, and 3, some CBCR specific instructions, and the source of data. Let's go to the next. Oh, yeah. Constituent entities, before I forget, it's any separate business unit of a group that is included in the consolidated financial statements, or any business unit that is excluded from the group's consolidated financial statements solely on materiality grounds. Let's go to the next. I provided these empty tables just as an example. The first table has the information of the tax jurisdiction. This information is consolidated. Say that you have 4 entities, 5 entities in a given tax jurisdiction. The revenues are consolidated. So you have you have different fields for unrelated party, revenue, related party, and you have the total. Go back to the table 1. Yeah. We have the profit. We have the income tax, tax accrued in the current year, stated capital, accumulated earnings, number of employees, tangible assets other than cash and cash equivalents. In these cases, for filling this table, sometimes you can fill in negative numbers, as it is the case of revenue for the consolidated countries where there is a loss. In other cases, for logical reasons, you cannot have negative numbers, such as number of employees must always be positive, stated capital as well. So I think we can go to the next table. Table 2. I think that we are skipping one. This is table 1. If we go to table 2, might have omitted. I think it's not. Can you see if you, Angel? Can you see if you have a little bit lower? Maybe table 2 is not. Yeah, there you go. So this is the list of constituent entities of the group. They need to be included per tax jurisdiction. So as I mentioned in table 1, you see the consolidated revenue. And in this case, you mentioned the individual constituent entities as per the definition by the OECD. You mentioned the tax jurisdiction of organization of incorporation. And you need to mention the main business activities, whether we have research and development, holding, managing intellectual property. You can see that it covers most of the industries, but in case you have other, and you can explain in table 3. If we go to table 3, I think there is another one a bit earlier, maybe. It's one before. Okay, we go to table 3. No, this one. There are certain specific instructions. You have to report who's the ultimate parent entity, reporting jurisdiction, accounting standards. And by the way, I want to emphasize that what the tax authorities are looking for, and also the guidance of the OECD recommends, is that the sources used for preparing the CBCR, they ideally must be the same year after year, and with the same standards, of course, using IFRS or depending on the local requirement, US GAAP, or the source of data. It has to come ideally from the same ERP. In the cases where multinational companies have different ERPs in specific countries, and this needs to be converted. and also translated into the accounting standards so that the information is consistent. At the level of data, this is all internally, of course. We're reporting currency. In many cases, by law, it says euros or tax units, depending on the country, and the period covered by the annual template. If you go to the next slide, please. We also, the table, from table 1 to 3, you have to specify which is the source as well. The ERP, table 2, if you are extracting the information from the master file, as we discussed in the beginning, the CBCR report, the master file, and the local files must talk to each other. Otherwise, you would be creating a risk. And table 3, you use the central bank website, for example, the CBCR, internal CBCR manual, or using the guidance of the OECD. And we go lower, next. Yeah, there. This is a suggestion of the roles and responsibilities for the collection of data by the internal departments. We have the finance, IT, the transfer pricing department, in case it's separate from the tax department. So we see that the collection and retrieval of data points defined by CBC reporting, who has, in theory, this can change, of course. This is just an example. It might look completely different in your organization. Maybe there is the accounting department that oversees certain information. So this needs to be properly defined before, well in advance, I would suggest, to define properly who's gonna provide what information. This is to avoid mishaps when the deadline is coming close, and because you really need to be consistent with the information you are presenting. Because if this information is communicated to a different tax jurisdiction, then there is some sort of additional intelligence there that might be a little bit, a bit tricky for whoever is in the head of tax position. If we go to the next. So we're also going to explore some other challenges. These are just a few examples of, there can be many other, but many other cases, but we have compiled just a few. If you go to the next slide, for example, there are many cases where the ultimate parent entity can be there can be conflicts. For example, the company ACO is the ultimate parent entity of a multinational, and it's a stock-listed company where a group of related companies have an interest of over 50% on ACO, for example. So as a suggestion, and whenever, if you encounter this situation, I would suggest to go over the substance over form. You need to consider economic substance and control rather than just legal form. Consolidated reporting, explore possibility of consolidating reporting where financial and tax information of the listed entity and its related companies are aggregated. You do a control and management test to determine which entity within the group exercises the most significant influence on the decision-making process. Local jurisdiction cooperation, discussing with the local tax authorities what their understanding is, engaging in a conversation. The documentation and explanation, this is going back to table 3, where you need to state specifically the reason of why there might be a conflict of the UPE. Continuous monitoring for dynamic business reasons. This can change given a merger and acquisition process or restructuring process, or also you need to go into legal consultation Here at the TPA, we're here to help you throughout the process of compliance with CBCR. The second example, the joint venture arrangements between two different groups, where each group owns 50% of the shares in the joint venture. It also raises the question on which group belongs to which part of the joint venture. Also, as a second example, reporting financial information in Table 1 for the CBCR report, the consolidated financial statements or separate entity financial accounts. And this is, just to give an example, in certain industries, it might be a little bit, I would say, challenging which information you must report. Ideally, it must be consolidated and translated into a specific reporting standard. And an issue being confronted by groups is whether financial information at the jurisdictional level should be presented in Table 1 based on information prepared for purposes of consolidated financial statements or information sourced from separate entities' statutory financial accounts. And it's not uncommon to encounter situations where the audited financial data at the subsidiary level differs materially from the consolidated data available to the ultimate parent entity. We have to go case by case. For the reporting revenue, do we look at gross or net? In the financial services industry, for example, it has been observed that some situations could arise where related party transactions revenue might be negative if reported on a net basis. Like, for example, where the interest revenue is reported on a net basis. And the OECD guidance on reporting of revenues does not specify whether gross revenues or net revenues should be used. Some groups have considered whether to use gross revenues. However, reporting revenues on a gross basis would lead to considerably larger revenues being reported in the CBCR report. And that would be reported instead at the consolidated P&L. So you have to keep an eye on that. Potential tax risks. There could be an overstatement or understatement of revenue lines. As an example, in the oil and gas industry, it's very common for groups to enter into production sharing contracts, and several parties set up a joint operation entity. And in this infrastructure sector, it is common for contractors to form a consortium and set up a joint enterprise to execute a project. And under accounting standards, applying to joint arrangements, revenue from joint operations could be recognized in the accounting statements, either in the revenue line, which would be disclosed in Table 1 as revenues, or investment using the equity method, which may not be disclosed in Table 1 revenues. So following the accounting standards could lead to revenues perhaps being perceived to over or understated. So this can be dangerous. You have to be properly explained in Table 3 of why this is, which revenues are potentially being over or understated. And some groups may historically have not been introduced to transfer pricing policies, so the outcome of can be a lack of financial performance consistency with respect to foreign subsidiaries performing similar functions. And this would be for the lack of consistency, of course. Number 5, does the profit loss before income tax in Table 1 include payments received from other constituent entities that are treated as dividends in the payer's tax jurisdiction? And well, the Action 13 report is clear that dividends from other constituent entities are excluded from revenue in table 1. It does not provide specific instructions as to whether or not dividends from other constituent entities are excluded from the P&L. And investment funds can also, in this case for investment funds, there is no exemption for such. The governing principle for investment funds is to determine if a group follows the accounting consolidation rules. And for example, if the accounting rules instruct investment entities not to consolidate with investee companies, for example, because the consolidated accounts for the investment entity should instead report fair value of the investment through profit and loss, and then the investee companies should not form part of the group or be considered as constituent entities. But this has to be, as I earlier mentioned, be examined on a case-by-case scenario. We go to the next. I think that we are running out of time, so if we can maybe jump to the public CBCR. We'll give you the floor, Angelo. If we go to the next slides, I think we already discussed some of the conclusions.
Thank you very much, Gerardo. So when we say public CBCR, we refer to the EU public CBCR regime, which ended in the adoption of a directive, which is the 2021 2101 of the 24th of November 2021. Directive has been adopted by the Council and the European Parliament in this time, but it has been given 2 years to implement for member states in their national legislation. It follows a trend which one set by the OECD, which is the financial transparency and in general corporate financial transparency. We see here the directive that were first adopted in 2013. You will see the number 34, which is the accountancy directive, and it is related to the directive that I'm talking about public CBCR, because it amends that same directive. In the same year, there is also number 36 of the year 2013, which is the one on capital requirements, also known as CRD4. This is for those companies that require prudential supervision by the national authorities. And we will see why it is important, because there is an exemption based on this one, which is mentioned in the 2021 directive. So as a bird's eye view, we see the 4 constituting elements of the directive, which constitute minimum standards, and minimum standards in the lingo of the European law body means basically directive sets these minimum standards, but then in the implementation of the same legislation into the national body of law, each state can enlarge the scope or add additional requirements if they do not modify, of course, the core of the directive. This is also a phenomenon called as gold plating. So the constituting elements start with the come into effect of the directive, which has been 20 days just by after the adoption. The timeline that the states had to implement the directive, it could have been earlier, of course. You will see later in the timeline, or it can be the case that the directive is implemented later by certain states. This is happening. There is the threshold of 750 million that Gerardo talked about under the BEPS, and it is still relevant. It is a threshold which has to be reported in euros. The European currency is the standard, and information to be disclosed as the same data set that is required under the OECD report, with just a minor difference. So this is the timeline I was talking about before. So there's just 20 days between the adoption and the entry into force. Then the transposition period, which has been respected and has also at the same time not been respected, but other countries. And that's why in the reporting that starts on the 22nd of June 2024, ideally, well, I mean, this is provided that the directive has been implemented already in national legislation. But that's a usual pattern that happens in the practice of the implementation of directives by the 27 member states. So the main articles that the directive uses to amend the previous one, 2013-34, are Article 48A, B, and C. But the terms used into the latest directive refer to the previous one. Hence why I mentioned it before. For example, on the scope, I mean, which kind of subjects does this directive apply? It says, well, it is EU-based and non-EU based. So as the first requirement of EU-based, what does the directive refer to? It refers to if there's a group to an headquarter that is situated in EU territory according to the law of the member state in which it is situated, you see incorporated in brackets. But if not a group that's a standalone undertaking and still it's included, like falls within the scope of the directive, the revenue threshold, which is reported as 750 million of euros, must be considered. So what can be considered as revenue? And the term we find in the list of the 2013, the previous directive, what is revenue? So it must be defined within the financial reporting framework and on which the financial statements are based, or also the same meaning for the purposes of directive and report is the net turnover. If a certain EU member state doesn't apply any of the most known reporting standard. The threshold hit must also be considered for the last 2 financial years, and this is a consecutive requirement. So it must be first, second, and then on the 2 reporting. The non-EU based subjects for this directive refers to the headquarter located outside the EU, but that it has a qualifying presence inside the European Union. The headquarter should control actually the qualified presence. The previous directive 2013 mentioned micro, medium, and large size enterprises. I reported the requirements because these directives must be read conjunctively. So if it's medium size, if it does not exceed 2 of the third requirements reported, 250 employees, balance sheet total 20 million net turnover. If it does, then it's considered large size enterprises. Nonetheless, these are considered to fall within the scope. Qualified branch, there is basically, this is a definition I found also in the restals. So means a subsidiary, so another entity controlled by the HQ located outside the European Union, which is a subsidiary that has the fixed place of business or permanent business activity in the EU territory, any of the member states. Same threshold applies. For the disclosure obligation, depends whether it is EU-based or non-EU based. I use the same term that Gerardo mentioned before, ultimate parent EU-based. So this is the ultimate parent entity must report. So the obligation depends on them. Or the qualified EU entity if it's the a part of the non-EU group, but that's the entity that is basically based in the European Union. The reporting obligation consists basically in a procedure. It is called public for a reason. So there is the first step, which is basically the filing into the special registry, trade registry or commercial registry, depends on the wording used by the member state in implementing the directive. But at the same time, the ultimate parent must publish the report on their own website. And so it can happen if it is a non-EU subject that the headquarter can delegate the filing to the EU entity controlled while publishing on their own website the report. I mentioned the directive of 2013, the number 36, about the CRD capital requirements directive. Again, the subjects that require prudential supervision are divided mainly in 3 categories: credit institution, investment firms, and insurance firms. The exemption stands for a reason because these kind of entities were already required in force of this directive in 2013 to disclose the same data set that is present in the current directive in the CBCR. hence why they're excluded. Doesn't mean they're excluded because they don't have to. Yes, they have to, but for another rationale already. And then it could overlap simply because of that. When reporting, the report should cover all the information at group level, but then there is a different basis to check also and to cover each country that the group has business into. So must be separate for each member state, separate for each jurisdiction included on the EU list of non-cooperative jurisdictions, and by this they refer to the EU Council decision about a non-cooperative tax jurisdiction. There is a blacklist and there is a grey list, must be separate for both. The only difference is how non-compliant are with the initiatives against harmful tax practices. The rest of the data should be aggregated for the rest of the world. So if not in a grey list, in a blacklist, or in a member state, you can directly aggregate data in the report for countries outside the scope. The disclosure components basically are the same as the BEPS, except for two exceptions, which I think is the tangible assets first of all. But we might be using that in another webinar, Gerardo, like in the future. So to check every detail that highlights the difference between the CBCR report and the directive. That's it from my side.
Thank you, Angelo. Unfortunately, we have run out of time, and I really want to thank everyone for attending this webinar. I want to invite you all to also look at the Pillar 2 webinars and also the VCA webinars. If you have not, I highly recommend you to have a look at them. Unfortunately, we cannot discuss a CBCR and Pillar 2 simultaneously, but I would really invite you to go into the website and have a look at for yourself. Thank you, everyone, for your presence. I hope this was useful. We are open for communication. Please send us a message or an email, and just to see how we can help you with your filing process. And thank you, everyone. Angelo.
Thanks, Gerardo. Thanks, everyone, for joining.
Enjoy your morning or your afternoon, evening, from wherever you are joining us. Thank you.